Welcome to Oregon Cash Flow Pro. I am going to give you an update on our H.Y.D.E portfolio. That's the high yield dividend ETF portfolio that we've started accumulating in our Roth and our after-tax brokerage accounts. But I'm also going to take some time to address some of the criticisms and concerns that people have around some of these ETFs. You're going to want to hear this. I think it's important, especially if you have any interest in this. Or if you've had interest in the past, you listened to some of the criticism and decided, I'm just going to stay away from that. I just might be able to address some of these concerns in a way that makes it make sense that you might want to reconsider these. Now, I don't care if you reconsider them or not. It doesn't matter to me. There's no pump and dump with these things. So whether you decide to buy into these or not makes no difference on what I'm doing inside of this. As usual, I'm just trying to educate you folks so that you can do better with your finances. So if you appreciate what I'm providing here, leave a comment and let me know. And hit that like button and subscribe while you're at it if you haven't already done so. It is much appreciated and it helps to get the YouTube algorithm behind us so that more people can be exposed to the type of information that we're sharing. So if you found value in it, please help us out there. Let's start by addressing the elephant in the room, which is this right here. You can see we're now up over $6,000 a month. We're up closer to $6,400 a month in our dividends that we are going to be receiving. Now, as we've reiterated many times, some of that is classified as return of capital, and it's not all extra on top of what I paid for the shares. Anytime a dividend gets paid out, that amount gets subtracted from the shares. It doesn't matter what stock or ETF that you own. The share price will be adjusted. What we really would like to see is a share price that essentially holds steady or goes up and pays out a dividend. We really know that we've got something special on our hands that's not just going to whittle away to zero. Now, I don't expect that to happen in these, and we'll be talking about that here in just a minute when I address some of the criticisms. But when I tell you that we're making $6,400 approximately per month on this dividend income, that's the payout. We're not making that as profit. Some of it could be profit, a lot of it could be profit, but it might not be, and it's gonna vary from month to month. Now, the spreadsheet that we happen to track this in helps us to know, are we in the green or are we in the red on any particular ticker when we account for the dividends? Because total return is what matters here the most. And as you can see, we are in the positive on quite a few of these. We're slightly in the negative on a couple of them and a little bit more on the other one. But, this one moved down a bit this last week. It was actually in the green the week before. So we had kind of a big drop on this one. And the dividend came down too. However, we have a particular amount of time until these are playing with house money, at which point it's all profitable. So let's address some of the criticisms before I hop into the rest of what we normally go over in this, which is how the dividends are doing, what we got for distributions, our fancy charts, and what's our diversification looking like. We're going to go over all of those things. But first, let's talk about some of the criticisms that I've seen out there. There are a lot of really good criticisms regarding covered call ETFs, specifically covered call ETFs that are on a particular underlying, and essentially you get the same exposure as that underlying, except you're capping the upside by only selling covered calls. And some funds will sell covered calls at the money, some will sell a little bit out of the money, some will sell a lot out of the money, and that might be the only strategy that they're offering as something that might be valuable to you as an investor. Now, I'll leave that up to you to decide if there's value to you for a particular fund and how they're earning their income. Some people may choose to go in and out of particular stocks. Some might just like what they see for some reason and it attracts them. Normally, when I'm looking at a ticker, let's take Triple Q, and I'm looking at a covered call ETF on Triple Q, ideally, we're going to want to see something that is very close to it or beats it. Otherwise, we could just invest in the underlying and we will probably do better. In fact, we will most likely do better if we're not capping that upside. And this is really where a lot of the criticism comes in. It's easy to show over the last 10 years when we've had a really strong bull run in these major indexes that just owning the indexes would outperform any type of capped upside covered call ETF. Now, maybe not all of them, but there are people that are looking at the history of these and coming to that conclusion. There is a lot of validity to that. If you can't beat the underlying, why not just invest in the underlying? Now, that is an actual question that deserves an answer. For some people, if you're going to just be in the stock market, and if you can handle a buy and hold strategy in an index like that, and you have no need for the cash right now, then that question makes sense. Why would you not just be in the underlying if the underlying outperforms the particular covered call selling index? That's capping that upside. You can always just sell some of those shares, and you're most likely going to be better off. Now, while I agree with a lot of the criticisms that people have about these things, in this regard, you're not going to outperform the underlying. Why not just be in the underlying? Why not choose a different one that has a better track record? A lot of these things are relatively new, and the dividends being paid out are pretty high and can entice people into thinking that those dividends are all profit, which they're not. Now, I'm going to actually put out a video on return of capital later this week or next week, as soon as I get a chance to put it together, so you can understand why seeing return of capital in some of these is not what you think it is. It's not just you getting your money back. And I'll give you a hint. It has to do with harvesting extrinsic value from options selling. There are ways that we utilize it, and I personally utilize it, that these income ETFs are using certain strategies in order to classify it as return on capital, but you're not actually just getting your money back. There is actually profit developing inside of these things. So be sure to look out for that video if you're interested in understanding more about return of capital. Back to the case at hand. Valid criticism, but there are valid answers that may make sense to say, well, maybe you shouldn't just invest in the underlying. Your goals may be different. Portfolios are generally made up of diversified assets, and your diversified asset may include stocks, bonds, index funds, real estate, businesses, high cash value life insurance, hopefully not low cash value life insurance, annuities, treasuries. There's all kinds of things out there that people can invest in, not just the stock market, in order to meet certain investment goals or comfort in having a portfolio that might be more or less correlated to any particular movement in a market. Meaning, if I'm heavily invested in real estate, but it's all in one county, and that county relies on jobs from one major manufacturer, that's a very high-risk portfolio if that manufacturer goes out of business or just moves that factory and those jobs elsewhere. That's way too concentrated of a position, even though real estate in general can often be a pretty good investment. Same thing if you decide to have all of your portfolio inside one particular company's stock. You run a very, very high risk that if something happens to that company, it could devastate your portfolio. On the flip side, these index ETFs provide safety because you get a basket of like the best and the biggest companies out there, and they're not just going to go to zero. Things are going to go up and go down, but on average, they just keep trudging ahead and going up. And there's a lot of safety in that because you're not concentrated in one position with one company. Now, a thing like the S&P 500 is heavily concentrated in the American stock market and the economy of America. It's not diversified outside of that by much, if at all. So how do you get some other diversification? A financial manager might have you have a certain amount of bonds. Maybe they're using treasuries. There's going to be some aspect of a balanced portfolio that's going to diversify you from just one position, even if that position is a basket of 500 stocks or 2,000 stocks, whatever the case may be, if it's all having to do with the particular stock market. There are other ways that we're going to look to diversify. I view these ETFs as a way to diversify. So why wouldn't you just invest in the underlying? Well, if your portfolio has exposure to that underlying already, to a degree that you're comfortable with. And let's say that you have a real estate portfolio that you're looking to expand. I really like to view these like adding to my real estate portfolio. Me personally, this is how I like to view these. If I have $50,000 that I have to go expand my real estate portfolio, I could take that $50,000 and I could leverage it with a mortgage and I could purchase a $250,000 house. That gives me a 20% down payment. I'm going to use other people's money. I get $250,000. I get some tax advantages for that, and then I can rent it out. Now, and the rents will pay back that mortgage and leave me with a little bit left over. That's the goal of real estate investing. And typically, a real estate investor might target a couple $100s per door in profit above their expenses and above paying that mortgage back. With the goal being 30 years down the road, mortgage is paid back. It's still going to continue to kick off rents. Those rents will have gone up over time. And now with the mortgage gone, it times it with retirement. And now you have this stream of income throughout retirement that's going to continue to increase along with rents. Okay, great. There are expenses along the way, not just the purchasing of the house. Hopefully the rents will be able to cover that, but you're going to encounter vacancies, damage. So you're going to have maintenance to deal with. Even if the tenants don't damage anything, there's going to be maintenance. You've got insurance, taxes, property taxes, income taxes on the rents. Now, there are some tax advantages when it comes to depreciation, but essentially there are all kinds of expenses that you're going to encounter and risks that you're going to encounter along the way. So it can be a good investment, but it's not without risks. On the flip side, I could take $50,000 right now and I could buy one of these high yield dividend income ETFs. I can have a diversified one with something like ULTY, where the strategies involve a number of different underlyings. lfgy, same situation, a bunch of different underlyings to go along with the strategy to earn income. I could go with something like qdte, where it has just the triple Q, and it's going to make its income selling 0 days till expiration covered calls. Now, it sells it outside the money. There are going to be days that it moves up so fast, it doesn't make money that day. It loses some money. But the underlying is triple Q. The underlying gains value. Overall, the share price is going to go up, and it basically mimics triple Q. Now, prior to the big drop earlier this year, it was outperforming triple Q by a couple of percent, 2 or 3% over the course of the prior year, during a high volatility time where it went down quickly and then back up quickly. Those quick moves up, it can't keep up with the underlying. We had quite a bit of that this year. So now it's underperforming. If we go back from the beginning, now it's underperforming by a number of percent. It's still doing well though. We're up quite a bit on this position. On some of our other positions that I've held longer with qdte, we're up. We're up in a really comfortable manner, but it's been kicking off income. So if I take that $50,000 that's meant to expand my real estate portfolio in order to generate monthly income that I would bring in from rents, instead of buying real estate, if I buy a fund like qdte or lfgy or ULTY, I'm going to expect income to kick off right away. But I don't have maintenance. I don't have tenants. I don't have vacancy. I don't have property taxes. And the percentage that this is going to kick off is going to be way more than that $200 that I would be getting per door on rental real estate. Now, I don't have a mortgage to pay off in this scenario. But if we think of that $50,000 as the mortgage, how quickly does it pay me back? Well, if we did a fund like qdte, it's currently kicking off around a 33% return on investment. That's a 3-year payback. Remember, the real estate, it's going to pay back that mortgage over 30 years. And then I start to get the excess from that beyond the $200 per door that I'm planning on getting. It's going to be just a little over 3 years since our ROI on the current dividend is 33%. You go to lfgy, it's a 63% ROI right now on the dividend payout. Now we're talking less than 2 years. ULTY is a 91% ROI. It's going to take just over a year to pay that mortgage back. And then it's all profit. Now the dividends are going to vary here. So do your rents. These dividends could go up, could go down, could stay the same. But they're going to start out way higher than if I just buy rental real estate. Let's take the case of ULTY. $50,000 right now would buy you 9,140 shares. That's an $834 dividend a week, not a month. You're going to be getting over $3,300 a month. That's very similar to the rent that you might be able to expect from a $250,000, $300,000 house right now. In fact, I guess it depends on the market that you're in, but you're probably not even going to quite get that much, except we don't have a mortgage to pay back. We've got the 50 grand that we're trying to recoup, and that's going to happen in a little over 1 year. I like the sound of that. So when I'm comparing this ETF and dropping that 50,000 in, I'm not comparing it to an underlying. I'm comparing it to the alternative investment that I was looking at doing. ULTY doesn't only have one underlying either. So let's look at $50,000 in qdte right now. Will buy you 1,409 shares. That's $291 in a week for that dividend, or just over $1,000 if there's 4 weeks in a month. But some months there's going to be 5 weeks, which means you're over $1,200, basically over $1,300. That's a pretty good deal on an underlying that's actually has the ability to increase in value as well. And because the underlying is triple Q, that should stick around for a long, long time. It can continue to kick off those dividends well after it's paid back with very little risk, in my opinion. That's how I see it. LFGY is going to fall somewhere in between those two. But the payback period on that original 50,000 is almost 3 years, or just over 3 years on this one. 3 years, just over a year, little under 2 years, compared to a rental property that's going to take a heck of a lot longer at $200 a month. And I can do this from my house. I can do it from my bed if I wanted to. This doesn't take any effort. I don't have to find any tenants. I don't really have to do anything for this. So there's a lot of reasons that this attracts me as an investor when I'm thinking of expanding my real estate portfolio. Now, there are other ways that you can look at this. You're going to have to decide what you do within your portfolio. But I've been really wanting to expand my real estate portfolio. I haven't liked how the market's looked for a couple of years now. So I really like what I've been able to do with this and save myself the headache of a lot of the real estate issues going on. It's just a saturated market at the moment. And where I live, it's not great for getting high rents or being able to purchase inexpensive properties. Whereas these, I can get in with $20. I can get this started. So the barrier to entry on these is very, very low to get started with these rental properties. Let's wrap this part up and show the portfolio. We'll continue to talk about this week to week. And if you have any questions about it, put them in the comment section below. But I definitely think that there's a good place for this, certainly in my portfolio, based on how we look at it. But I do have exposure to indexes in the market in different parts of my portfolio. And what I do with the money that this kicks off, I can reinvest that in other areas as well. So hopefully you have a good financial advisor, or if you're your own financial advisor, maybe you have a good plan on what you can do with the income that comes in from your income generating assets. This doesn't have to be the only income generating asset that you own. There are a bunch out there. We mentioned real estate, but you could go buy vending machines or a whole host of other ways to generate some type of ongoing income that's not buying indexes in the stock market. So this is one alternative. And realistically, I really like what some of these are doing. One more quick example. LFGY and ULTY. They make money trading options. That's a business in and of itself. They don't have an underlying like the triple Q. They have a basket of stocks that they're using for their trading strategies, and it will change based on what high volatility is available out there. Being able to utilize options to generate income on volatility alone is a special skill. Just like any other specialized business out there, it takes a certain set of skills to do. I'm doing this. I'm showing how it works in my 0% credit card challenge that we're doing right now. Look for those videos out there, and you can see what types of trades that I'm doing. They're very similar to what you see happening inside here. And there is a very, very real way to make income. So I don't view these as a stock alternative. I'm basically buying a business. I'm buying the skills of the professional traders that are making income selling the options inside these funds. As a retail investor, this is amazing, especially if I don't have those skills personally to be able to go do that. I can outsource that now. This didn't used to be available to retail traders. I think it's amazing what they're able to do. And if you go look at the videos that I'm showing you with that 0% balance transfer challenge, you'll see it's not easy. It's time consuming. The amount of money that we can make doing it is excellent, but it definitely takes some time and some skill that not everybody has, one or the other, or even both of those things. Now, I put that information out there and I show it because I think if you want to learn how to do it, I want to help. I want to share what I've learned, and I show the strategies and we talk about them. This channel is about education, after all. But a lot of you will see those and go, that ain't for me. That's complicated. It is, and it's time consuming. You can outsource that now to these guys, which is pretty cool. And I think these will continue to expand, especially if people understand that, if they get the popularity behind these and realize this is a business. As an investor, I'm treating it like a piece of rental property in my portfolio because of how it kicks off income. But essentially, I'm investing in this business, the business of making income on high volatility here. In this one, I'm investing in the business of selling call options with 0 days till expiration on triple Q. On this one, I'm investing in the business of selling put options against a Coinbase ETF that's 2x leveraged. That's all they do for this one is sell puts or put spreads. So it's good to understand what's going on inside of these things so you know what kind of exposure you're getting and the overall risk for where it sits in your portfolio. Now, if you go buy real estate, not all of your real estate is going to turn out to be a winner. You might end up picking up some that don't pay off. And that will probably happen in some of these covered call ETFs or income ETFs. I'm not a big fan of just selling covered calls. It can have its place because when I got into qdte in my other position, it was because I wanted to have exposure to the triple Q, but get that income to kick off. Because that was part of one of our other challenges where we borrowed $10,000. I had a loan to pay back. I borrowed $10,000, we bought qdte, and the dividends are paying back that loan. If I just took that $10,000 and bought triple Q, I could do the same thing, but I've got to decide when to sell. I've got to decide if I want to do anything else with it. Do I want to sell covered calls inside of it? Do I want to try and make some additional income? How do I protect the downside? What happens if it just falls? So ultimately, I thought it was a really good way to approach it, along with a challenge, because these things were new when we decided to start this. Can I just use it, take a loan, buy the shares, have the shares pay the loan back, and then I just own the shares? Once the loan's paid back, those shares are going to continue to kick off income. And that was kind of the eye-opening experience that told me, oh, these work like real estate. All right. I think we've exhausted this subject for this video. Moving on, let's see what we've got going on. Our current dividend income now is up to $3,800. Let's see what we expanded on. Our cost basis. We added some coyy and some blox. Just a little tiny bit of blox. But we did add 100 in coyy the week prior, which kicked up our dividends this last week. So we're up to 3808. Here's the last dividends that paid out. And you can see this one went down slightly. This one went down slightly. This one went down slightly. This one went down quite a bit. This is down slightly. This one up slightly. And then this one down quite a bit over the 3-month average. Now, this is not just down slightly over the prior week. I mean, it is just down slightly over the prior week. And it's possible that some of these are up slightly from the prior week. But adding 100 shares of coyy really kicks up our dividend payout. You could see, even with 416 shares of coyy, this is now our highest dividend payer for the month, surpassing lfgy, which has a considerable amount of more money into it. Now, we're waiting on a dividend payout, which should push this up positive. As soon as we get that, beginning of this next week. But lfgy has been doing really, really good over the last couple of weeks, bringing the actual share price back up. And we're sitting pretty on this one now, up over 10% for a total return. qdte, we're at 14% on a total return for this one. This, you can see the current price, though, down quite a bit from our average paid price. Whereas lfgy, it went down to like 32 and it's climbed back up while continuing to pay out dividends. Just amazing getting it back up. MSTY, fairly small position, but the big dividend paid out the other week, and it helped to catch us back up a little bit. The underlying also bounced back a little bit, so let's hope for more of that. XBTY, this one took a big drop and hasn't quite recovered from a couple of weeks ago. Going to keep an eye on that, but we're quickly getting to where we're going to be money printing. The expectation is about 12 months if we can pay out close to this 3-month average. If it only pays out this, it's probably going to take us a little bit longer. ULTY in the positive, love to see that. Blox, this one's the big winner right now. Blox has just been crushing it. Their plan, their internal plan, they would like to see a 50% return on their income that they make by selling options, of which they pay out 36%. Now, we're not at 36% here, but that's because the share price jumped up. So we should continue to see this go up as the share price goes up. That's kind of the expectation here, unless they decide to keep it at 36% of basically where the original share price was. That could happen as well, in which case this will continue to go down if this goes up. And if this goes down, this will climb back up to 36%. So 36% goes to dividends. The other 14 goes to grow the NAV. That's kind of what their goal is, which I like. I like that a lot. Coyy, this one was positive for us last week. Coinbase took a bit of a dip. Now we're down into the negative, but this one is going to pay back so quickly. Now, here's the thing. We own 416 shares. If I stop buying these shares, it's going to continue to kick out the dividends. So even if these shares are worth less money, I still have the same number of shares. The only thing that matters to us right now, if I don't plan on selling these shares, is that dividend. We want to see that dividend continue to pay out for a long time, well after it's paid back the shares. That's the goal of this. Now, I like getting that payback really quick because I can take that and deploy it into something else. We don't let money sit idle around here, do we? So, going to be pretty cool. Our distributions, you can see, jumped up a little bit from a couple of weeks ago. This one had one of our monthly payers, so it was kind of outsized. Looking at it from a chart standpoint, that's what it looks like. And this is my new favorite chart where we're tracking things. You can see the dividends that were paid out, the current value of them, of the actual underlyings, or the current value of the shares, the total return. We had both of those together. And where is that in relation to our cost basis? And here it is in pretty colors. lfgy, just crushing it. And it happens to be our biggest position. So we're pretty happy with where we're at here. ULTY, we're still above our cost basis. Like to see that. xbty, we were above it. It just dropped below it with the dip this week. So we're looking to see that recover. msty, same situation. This one's kind of been struggling for a bit, but it's actually starting to catch back up. Blox, kind of the big winner in this regard. Look at this red one. It's the only one that's like well above our cost basis with the current value. We only just started accumulating this, so we don't have very much dividends paid out yet. You can see we got $124. We're up almost $800 in total return. Pretty cool. Anyway, eventually what we're hoping to see is all three of these colors surpassing our cost line at some point in the future. That's what we would like to see. It's possible that the red one on all of these or any of these just continues to go down as that dividend gets paid out if they're not actually making money. But if the blue line gets above the green, we've recouped all of our cost anyways. And ultimately, as long as this yellow one goes above the green, it's a profitable position overall. We looked at our cost basis change. Let's go to our diversification. We're tracking the different funds, the advisor companies, and the fund managers. These are the people doing the trading. These are the people coming up with the strategies, and these are the people managing the options trades. You can see how long they've been in here, and then what is our exposure to them. This is where we want to make sure that we're diversified. We don't want to have everything all tied up in just YieldMax. We don't want to have everything just tied up in Roundhill or Granite shares. They all employ slightly different strategies. Some of these may pay off more at different times of the year and in different market environments. So looking to continue to diversify this as we go. That's it for our Roth accounts. Let's look at our other ones. These are our after-tax brokerage accounts, and I actually added a line down here, and I'm probably going to add that to the other one as well. This is our months until money printing. This one utilizes the 3-month trailing average, and a lot of our last dividend pays are lower than that 3-month average. So I thought that there might be value in knowing, what if it stays where the current dividend is at? How does that affect our money printing? Well, here with Bito, it dropped quite a bit. So this 3-month average, it would be 20 months that it would pay it back. But with the current dividend rate, if it stays at that one, it's going to take us 25. 5 months is a big difference. So I kind of want to know that. gdxy, the dividend went up. So we could potentially be money printing 5 months earlier. Really like that. Coyy, remember, we were slightly negative on the other one. We're slightly positive on this one. In fact, these are all looking really good. We really like where we're at on this portfolio. But coyy, it goes from 7 months to 9 months. That's not that big of a deal. Not when it's kicking out really big dividends. We like to see this one. I still like this position, and I still like adding to this position in the current environment. I think we're going to continue to see this one do better. Blox, the big winner. Now, I didn't add to this one, so our actual average price paid is very low because we haven't added to it for the last, not since we originally bought into it in these accounts. So it's looking really good. We've got 34 months until money printing, but we're up 23%. We could essentially sell out our original position and still hang on to a handful of shares. We're not going to do that though. We expect that one to do really well. ULTY positive, qdte positive. This one I've had a lot longer than in the other one, than in our Roth accounts. This one I've been holding since January of this year. So we rode that big dip in the market and then came back up, and we're back to positive on it. Received quite a bit of dividends to date. This is our biggest one in these after-tax brokerage accounts. And you could see our monthly, about $2,600. So we've gone up a little bit. Where did that come from? Let's look at our cost basis. We added some coyy this week, and we added some coyy. No, I think that was the only change. I think we addressed this one before. So our actual distributions down slightly because the actual distributions came down on almost all of these this week. There's what it looks like. In general, we're going up. And over here, lfgy, big winner, qdte, looking really good. Blox, crushing it here. Even in ULTY, we're positive on a total return. Coyy, we're positive on a total return. And these two, gdxy and bito. Really like what we're seeing here. And here's all the numbers where you can see real easy. Dividends earned, current value, total return, and cost basis. Let's finish this up. Looking at our diversification, we added a little bit, but not a whole lot this last week. So I think Granite shares ended up coming up. That's where we're at now. I have none of these set to automatically reinvest the dividend. So when these are kicking off dividends right now, we're basically sitting on the cash. I'm doing options trading inside of these accounts. Ultimately, when I get to a comfortable cash position, we add more shares in order to expand these. So I don't just take the dividends that it's paying out and add more shares. I might have some options positions open, but I do value sitting on some cash inside these accounts just in case we get a market drop, because I would rather wait for something to drop and then add to these. Now that may not pay off with Blox. Blox would have been a good one to do the dividend reinvestment because of how quickly it's moving up. And we would like to expand our position in Blox, but I'm kind of waiting for a good buy opportunity. Now, we may not get it. It might just say goodbye to us as it continues to climb. So sometimes you can't be afraid to buy into something that's going up. If, however, the entire market takes a downturn for whatever reason, it's possible we might get a better buy opportunity. And we're going to sit on some cash and prepare. I hope you guys found this helpful. I enjoy sharing this information with you. If there's something that I didn't cover or you're wondering about, let me know in the comments. See you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.